quick whistle stop tour, if possible, on what I still believe is one of the most exciting sectors to be invested in over the long term. Maybe some of you have seen me on this platform before. If not, well, hopefully I'll leave you with a sense of the excitement that my team has around investing in technology. The title of our presentation is about a risk reward that's much improved. And I think that's really in contrast to where we were last year, when obviously the Fed started to adjust interest rate policy for an inflation backdrop that was unfortunately not proving transitory as hoped. Anyway, we'll come back to market movements in a minute, but I think at that point, risk was repriced, and it's been a very difficult market for growth stocks, tech stocks, and anything really that what we would call long duration companies, where their value is very much at the sort of end or later in their life cycle. Anyway, I'll come back to that. This is the team. Hopefully you can see the slide well, and it's a large team. It's one of the largest, most experienced tech teams in Europe. I've been at Polar for nearly 20 years. I've been running the Polar Capital Technology Trust since 2006 as the lead manager. I've been working with Nick Evans, who runs one of our actually slightly larger open-ended fund since 2007. So this is a very experienced team. We've lived through some ups and downs, and when technology manager says ups and downs, they really mean it. And so a strong track record through multi-cycle, and that's important because while history doesn't repeat, it rhymes, and some of what we're seeing right now in the market we've seen before, and actually it's being able to apply that knowledge is obviously fairly helpful in trying to avoid potholes and pitfalls of investing. So very quickly, this is the backdrop that I'm sure you're well familiar with. That 2022 was a very challenging year. It was all about inflation, of course, and tighter financial conditions, cost of living crisis, energy prices, war in Ukraine, and inflation at levels that we haven't really seen before. Many people in the market, I've been doing this now for quite a while, and I haven't lived through a period like this. In fact, I've been a very lucky investor to have lived through a disinflationary backdrop for much of my career, and now we're seeing rates of inflation that we haven't seen before. Thankfully, that's coming down, and I'm not going to spend too much time on the macro, but I wanted to just kind of highlight the fact that 22 was challenging because much higher interest rates puts very significant downward pressure on valuations, and in the main, that's what the tech sector suffered from: compression of valuations. So here you can see on the left-hand side the inverted PE of the S&P against CPI, but also on the right-hand side you can see the correlation, or the inverse correlation, between higher yields and software valuations, or cloud software valuations. So very, very significant compression. There were other things too, of course. The tech sector has had an incredible period, an incredible COVID, really. The world was sort of closed, shuttered, offices, and stores, and there was a rush to technology, and some of that has been unwinding, thankfully, I suppose, because of vaccines and the reopening. Not good for tech stocks, but certainly good for humankind, and so we've had that to deal with as well over the last sort of 12 months. The point, though, ultimately is that a number of things that were looking a bit heady 18 months ago, perhaps, now look much improved. Valuation is perhaps the most important of those, where you can see on the left-hand side here, this is a basket of cloud software companies where valuations have come back remarkably from, again, levels that probably should never have been seen, 21 times forward sales, a very different pandemic range of valuations, and now we have returned back to, well, below where we were before the pandemic, and back within a very long-term average, in fact towards the low end of that average. And that valuation reset has been very painful, but also quite remarkable actually in its magnitude, and what we're seeing as a result of that is what we've been doing in the portfolio, of course, is trying to buy some of these assets because they've become much more attractive, all things being equal, albeit against a slightly trickier backdrop. But private equity has been stepping in, and this very busy chart here on the right hand side just shows you how much activity there's been. At the beginning of this year, 80% of listed US software companies were trading at valuations on EV sales, enterprise value to sales, that was below where private equity typically is active. So we're seeing a lot of activity there. I think that tells you that for long-term investors, valuations in this space are much improved. Sentiment has also improved. The tech sector was at the center of everything during the pandemic, and then this recent survey by B of A just shows you that institutional investors were underweight technology. They were again, maybe ruining that over the last few days with all the calamity going on in banks and other financials, and tech actually looking like a relative safe haven, partly because we're not banks and partly because we're the best capitalized of all sectors in the market with net cash on our balance sheet. But the sentiment much improved, i.e. much less exuberance or just positivity towards tech. And also we've begun to see valuations coming down, earnings numbers trending down. Now again, we don't know where they'll end up, because the macro environment is tricky as a result of all of that monetary tightening, but nonetheless the earnings compression or reset has at least begun. Margins also, we're beginning to see technology companies do what naysayers say they never do, which is to deliver cash flow and profits. And again, haven't really got the window here to talk about this, but we've never really believed that we've never bought into the sort of bear case, obviously, that tech companies can't make money. Many of them choose to focus on growth for lots of very sensible reasons: early mover advantage, the network effect, this idea that winner takes most. If you think about Google with 90% market share in internet search, it really does pay to be the biggest player in the market, and so companies typically do that. They go for growth. But during more difficult periods where valuations have compressed and where growth is harder to come by, they can switch to a more profitable but slightly slower growth trajectory. That's what we're seeing, and I think they're doing that because they'll be rewarded by the stock market. And again, I think it's just a good reminder that when the real companies can do that. They can sort of switch from growth to profits, and we are, as I say, beginning to see some improvement in markets because of that. Valuations, again, they've come back. You can see here on the left, this is the forward PE of the US tech sector, and we had a big move during the pandemic. You can see that we've pulled back and we're sort of back. We've retraced again. We're now at 23 times forward earnings. I think the key message here is that on the right hand side, you can maybe see this better. The tech sector remains roughly in a range that it's traded at relative to the broader market that it's been in for a very long time, 1.3 times today, the broader market multiple. And I think this, the key point to draw out here is that this is not the tech sector of the late 90s, no profits, all sizzle, no sausage. This is a sector that trades in the sort of low 20s, not dissimilar to a market multiple, whereas once it traded at 50 times forward earnings at the top of the 2000 dot-com bubble, and more like 2.5 times the market multiple. So just not like that period at all, despite stuff you'll read about and how much apparently it's like the 90s. In our view, it's not. Next generation valuations, again, you can see just how significant the compression has been. This on the left is the internet sector. This would be Google and Meta, Facebook, and other companies like that, basically world-class businesses now trading at the low end of where they've traded for a very long time. Some of them trading cheaper than the S&P multiple, which I think is wrong. And on the right-hand side, you can see just the incredible compression in the best growth stories, we think, in the market. And again, trying to take advantage of that in the portfolio as we speak. Same story again in cybersecurity, another critical theme within technology. And on the right-hand side here, the convergence of the red line and the blue line is something that happens very rarely in technology investing, which is when next generation technology companies trade at a similar multiple to legacy companies. Very, very rare. The last time it happened was in 2015, 2016, and it did turn out to be a very good buying opportunity, but again, the backdrop then was tricky. We didn't have a recession in the end in 2015-16. I'm not clever enough to know what ultimately happens to the macro, but I do know the risk reward looks a lot better as a result of this chart. Our portfolios are a kind of a broad church, a diversified approach to tech investing. I won't spend much time on these stocks. I'm sorry, I just don't have the window. But the most important takeaway is that we invest across a range of themes within technology, and the key reason for that is that we don't miss big winners. Long-term performance is really driven by the avoidance of less good, bad investments, and not missing Apple, not missing Google. I've owned Google since the IPO. I bought Apple on the first day I joined Polar Capital in 2003. We haven't missed those ones for sure. And so, a range of sub-themes that we hold in a diversified way. This is those themes shown over time. And again, I haven't really got time to go into them. But the key is, as I say, we can move money from theme to theme where we see the best risk reward at any given moment. I have to talk about AI. It's everywhere. Microsoft is having an AI day today. Have a look online, learn more about this. This is, by far the most important tech theme. This is has the potential to become, the next big thing after cloud. And this is not a new theme. This is something that's been going on since really the 50s. The idea of computers trying to ape humans. And the excitement here is, of course, that a lot of things have to happen first. They've happened. The cloud, cheap storage, smartphones, and a whole bunch of very important technologies that have now finally collided and have got us to a point where we can store and process data very cheaply. And as a result of that, we're seeing AI happen. So I obviously have to show you ChatGPT. I'm sure many of you have heard of this. If your children are getting remarkably better or grandchildren are getting remarkably better scores at school, it might be because of ChatGPT, which has really taken the world by storm. 100 million people use the app. I think the fastest ever app to 100 million people. It sort of looks a bit like a supercomputer. It appears to be sentient. It isn't, but it can just about answer any question you ask it in a very human-like, with very human-like prose. If you haven't tried it, really you should, because it really is remarkable. And people describe it, I think, quite rightly as the iPhone moment for the AI industry. It's not just about prose. It's about the idea that with very large models and lots of very heavy lifting with computers, you can create new data using existing data, which has been, and by harnessing that existing data, create new content. And these are some images that have been created by the company OpenAI, which is the company that has behind ChatGPT that Microsoft recently made an investment in. And these are images that if you ask, it's called DALL-E 2, to create an image, it can create an image that looks like a stern-looking owl dressed as a librarian, for example. What's the big deal? It's a massive deal, because if you can do this, frankly, you can tackle content, you can tackle code, you can create images, you can even have machines create, again, music that hasn't been made before by a human. And I think we just have to remind ourselves, though, we're still very early in this process. So if you go online and you try those technologies and you find them as incredible as I do, remember that really this is still just day one. This is very much like this thing on the left-hand side, the first iteration of the iPhone. And what's so fascinating about this parallel, of course, is that the iPhone on day one didn't have many of the apps that people know about today. They didn't exist. There is a YouTube on there. But there are most of the apps that will be on the front of your smartphone, I suspect, are not present on the first iteration of the iPhone. And that's, of course, true of AI, which is that we're really just at the beginning of something, but that we should take it very, very seriously. This is probably the first time that it's credible to say that that computers and technology are viable competitors to humans. And so I think over time there's a very strong case here that AI will move from being an application to being something we call a general purpose technology, like electricity, like steel, technologies around which everything is reimagined. Just to finish up the portfolio, I haven't had much time to talk about the stocks. We're trying to invest in the best and most important assets within technology. We're trying to manage risk in the portfolio by making sure we don't have too little of the likes of Microsoft and Apple, world-class businesses that deserve a place in any portfolio, especially a technology one. Trying to avoid companies that are on the wrong side of history or legacy assets that might be nice businesses but are unlikely to grow, and then sort of aggregating them and trying to deliver a portfolio that delivers a lot more growth than the technology index, which you hopefully can see here, our sales growth weighted numbers, for a modest premium to the index on an EV to sales basis. I think with that, I better pause or finish up, and hopefully it was useful. Check out the website if you're interested in the story, and there's lots on there about AI and other themes that we're excited about. So thanks.